Today we thought it would be useful to speak about loan funds. They're extremely important in practice, but since 2007, 2008 and the financial crisis, they've been the subject of quite a discussion. Number of people will think that loan funds are extremely important because they in fact have been lending a lot where some traditional banks have gradually lent less money to the economy, and they have been crucial in the development of the economy over the last 12 years. Others see that phenomenon with a little bit more prudence and would think that it actually is not completely fair that an agent that is not subject to the same rules would have the same possibility to lend to the public. So the purpose today will be to look at that subject. In Luxembourg, a number of elements of the regulations are clear. The first regulation that would potentially apply is the regulation on credit institution. And you will be a credit institution if you receive deposits and repayable amounts from the public, and also grant loans on your own behalf to the public. And these two conditions are essential to be captured by the rule. Because funds do not collect money that is repayable to the public, they will generally not be subject to the rules applicable to the credit institutions. The second set of rules that is likely to apply are the rules that result from the law of 1993, and notably the Article 28.4, which relates to professionals performing lending operations. These provisions will be applicable to those agents who grant loans to the public on a regular basis. The law has explicitly provided for exemptions. These exemptions relate to SIFs, to SICAR, to securitization vehicles, but there is no exemption for AIFs generally. So what's the situation in that respect? The law foresees that status of regulation is only applicable to agents which provide loans to the public. The purpose of this was clearly to regulate those agents which would go from door to grant loans to the public. They may also be applicable to agents which would call different people on the basis of cold calls to provide financing to them. But when you have a loan fund, that's not the way it functions. The way a loan fund functions actually is that they pre-select a whole pipeline of deals, a whole pipeline of companies which they think will need at some point some financing, and after due diligence they will decide that it's actually a good portfolio management, a good investment to grant a loan to these entities. Sometimes as well, the loan is only one element in the context of a wider strategy to potentially acquire control of the borrower. So generally, in most of the files that we've seen so far, loan funds would not be captured by the law of 1993 and its section 28.4. The CSF in that respect has also quite usefully clarified that AIFs may originate loans irrespective of the regulatory regime that they will have elected.
We can basically see loan funds in two different ways. On the one hand, they provide much needed liquidity to the financial sector, and the fact that they are not submitted to the same regulations as banks allows more flexibility in structuring them and responding and changing the response to the different needs. On the other hand, they are not captured by banking rules and they originate loans, which is a concern for several authorities who have as competence the regulation of the banking sector and the financial sector as a whole. This concern is obvious from the different initiatives going on today around the revision of the AFMD. The EU Commission has published on 10 June its report on the revision of the AFMD. it spots a number of issues around loan funds, conveying issues already spotted by the FSB, around more specifically CLOs and leveraged loans, and the fact that data today does not provide enough information on activities around these assets. ISMA, on the other hand, in its review published on 18 August this year, has more affirmatively called for a specific framework for loan origination. That shows really the two different approaches that are currently proposed today and being debated. On the one hand, more data on CLOs and leveraged funds and on financial providers. And on the other hand, more regulation around the vehicle itself. In its survey that the EU has published on 22 October, and which is due to be completed by end of January 2021, both ideas came out and input is sought from the industry on both matters. It's important, however, to note that regulators need the information on what's going on in funds, loan originating funds, and it is fair to say, and they have said several times, that they do not have this information because the data is amalgamated with a number of other data because of the way the AFM Level 2 regulation treats reporting of this data. On the other hand, AFMD is not about regulating funds themselves. It's about regulating managers and giving powers to national competent authorities through the managers to then access to the funds. Regulating the funds would result in less flexibility on the fund structuring and would result in less, eventually, liquidity in our market. The ball is now actually in the hands of the different respondents to the EU survey, and we will see what comes out eventually of these responses and of the initiatives that the EU Commission will take after that. It is clear from the EU survey that more granular reporting is an option and that more granular reporting may require different and additional strategies under which to report.
The CSF has developed that concept where you don't grant an AIFM license to an entity without looking actually at which strategy the AIFM will be carrying on. So the CSSF looks at the various procedures and at the end of the exercise will deliver license, but only for the strategies for which the AIFM will have applied for. And what we see is, in the absence of a strategy which is a loan fund strategy, the CSF has been obliged so far to grant the license other, and therefore when the CSF receives the reporting on the loan funds, it's mixed with various other funds which are in the other strategy.
In fact, it was a point of attention from the CSF for numbers of years that IFM managing IF pursuing loan origination. The CSSF has asked numbers of questions and now focus on the fact that the IFM must be authorized for the right investment strategies. We have seen a change of position from the regulator. As of today, the CSF asks IFM to be licensed for the investment strategy of the underlying of the loan, and therefore, if a fund finances a private equity company, the IFM will have to be authorized for private equity strategy. In addition, the regulator has focused on the expertise of the main functions within the IFM: risk management, valorization, portfolio management. The consequences is that the IFM must establish policies and procedure regarding portfolio management, risk management and valuation, covering specifically loan origination, but also the underlying of the loan origination. If we look at the CSF practice over the last years in relation to IFM authorization to manage loan origination funds, what we can note is that the CSSF has really focused on the organization set up at the level of the IFM. And therefore, the CSF focus demonstrates that when a regulator reviews carefully authorization of IFM, they check a number of points such as appropriate human resources, appropriate technical infrastructure, appropriate policies and procedure, so that the risk which is identified at the European level in relation to loan origination funds is mitigated through the organization established by IFMs in Luxembourg. I know that at European level, they want more and more to regulate everything and anything. However, in terms of leverage limits, I really think that when an IFM establishes appropriate risk management policies and procedure, look very carefully at the liquidity needed at the level of the IF, there's no need to impose additional limits. As of today, the CSSF has looked carefully at the risk management framework established by IFM to ensure that IFM monitor appropriately and mitigate the risk linked to the investment strategy of a particular fund, whether this fund is a loan origination fund or not. And therefore, if we look back numbers of years now where IFM manage loan origination, what we can say is that we have not noticed any deficiencies in the risk management of these funds, and therefore why as of today this fund will be more regulated than others.
If I understand well, rules are under discussion for the moment. Here in Luxembourg, we're fairly confident that the rules as they are on the organization of the AFMs are good enough. They've been used and managed by the CSF in a very competent way. The CSF has, we think, been able to address the challenges that basically underlie all the questions that currently the ESMA has. I think that the quality of the regulation we have here is some sort of demonstration that we don't need to have specific rules cast in stone in the directive itself, but probably more discussions between the national authorities on the best regulatory practices could further help developing the knowledge, know-how, how to properly manage loan funds and their supervision. But obviously, this is a question that is currently discussed. There will be lots of fora in the coming months, also commenting on those questions and the answers, and we'll be happy to further discuss the question. We hope it's been informative enough to you, and we hope to see you soon.